Hello and welcome to DeFi 2.71 podcast. I'm your host Seraphim, and today we're going to chat with Evgeny from Re7 Capital, which is a liquidity provider in DeFi. We'll be chatting about how a liquidity provider invests, how do lending protocols work under the hood, and all things DeFi. DeFi 2.71 podcast is sponsored by Euler Finance. Euler is a revolutionary lending protocol backed by industry giants such as Paradigm, Lemniscap, Anthony Sassano, and Bankless. Euler Finance aims to democratize and disrupt the lending space by introducing innovations such as permissionless listing, MEV-resistant liquidations, tokenized debt, protected collateral, and many more. Phase 1 launch is scheduled for 13th of December, and check out Euler.finance for more information and exciting news. So welcome Evgeny to the first podcast. This is Evgeny from Re7 Capital, and it's been a long time since we've seen each other. It was like a month ago in Lisbon, which was, I think, quite a blast, wouldn't you say?
Yeah, thanks, Seraphim, for having me. It's good to be back in winter London. Lisbon was an eternity ago. It was a lot of fun, but yeah, now it's time to do some real work.
Yeah, time to ape into some shit coins, finally. So.
Well, not today. Clearly, we're in the beginning of a multi-year bear market. I mean, it's all over now. So
I hope your investors know that and they're aware.
Yeah, of course. Every week is the end.
Exactly. So, Evgeny, could you tell our listeners perhaps what your fund does, or your journey as well from traditional finance into DeFi? It's something that, kind of I lived through as well. So it would be interesting to see your point of view and what got you into DeFi, or what your kind of fund does within that space now.
Yeah, I've spent about 10 years in TradFi on the investment side. And as I'm sure you've experienced, once you discover Ethereum, once you discover crypto, it's a rabbit hole and you can't really go back. So once you start diving in, there is only one way to go, and it's further down. DeFi, obviously, in its current sense, came about, less than 2 years ago, where we had some humble and hopeful experimentation, which then led to the market growing 1000x in terms of users, in terms of capital deployed. And it's basically a whole new financial system being built by us and in front of us, where the value flows are reimagined, where people can come in and build. They can use the products in a much more open way. And we'll go deeper into this, but obviously this enables for a whole new industry to be created, because once you start treating finance as code, it changes things a lot. And at Re7, what we try and do is we try and support this ecosystem. So we provide liquidity to the early stage DeFi projects, whether it's lending, whether it's trading, whether it's insurance, or whatever else. And we basically aim to support the teams to be a kind of power user on day one, provide liquidity, and help the ecosystem grow, whilst at the same time delivering hopefully attractive investment results for our investors.
Isn't it interesting, speaking of TradFi to DeFi, that everybody jumps from TradFi into DeFi, but nobody goes back?
Yeah, I'm yet to meet people who go back.
You did? No.
No, it's impossible. It's once you see it, you cannot unsee it. It's not easy to accept what it is and understand all the implications. And realistically speaking, it takes many years. So, we've been able at Re7, we've been able to identify this as an interesting investment field, because we've been in the space of, for 6 years. And this is our third iteration in terms of what we tried to build. So it's not easy, but once you're in, there's no going back.
Nice. As someone who started out in traditional finance and went into DeFi, I'm sure you have lots of friends at hedge funds and banks who are like, what is this shit? Is it just hype? What's the kind of... To people that are still in traditional finance, how would you explain the value proposition of DeFi? Why is this a thing, apart from just get rich quick, hype, and NFTs and all that sort of stuff in there?
Yeah, honestly, I failed to explain it more times than I have succeeded. At some point, people just give up and say, you're just running a Bitcoin fund, right? That's basically what you do. And at some point, you just give up and you accept and you say yes. But in short, it's not even apples and oranges. It's a much broader and wider gap. So I try to explain this to people as, I want them to think about DeFi and financial products as apps, right? So we have our iPhones with an operating system, and then we have apps, and then we have apps on top of apps, right? Which is very different to how a financial system works today. So the very simple example I give to people with my banking background is, Imagine that you want to get a mortgage, then you want to do an FX transaction, then you want to buy a stock, then you want to give the stock to a market maker to generate some additional fees, and then you want to buy insurance on that asset. Now, realistically, unless you are, George Soros, it will probably take you, 3 to 6 months to get all the accounts opened and get the transaction processed. In in crypto and in DeFi, it will take you, 5 seconds basically.
Mm.
So everything exists as part of one flat platform. Everything talks to each other. Everything works together, and the whole infrastructure is just set up very, very differently. So just how your phone and your apps are more efficient than going into a branch and doing something physically, here you can get something very similar, and that's even before we talk about the software applications of that.
I think when it comes to efficiency, a lot of people are like, oh, it's more efficient, maybe, but where's the innovation? While there is innovation, efficiency is also innovation. We can travel to another country on horses or we can fly, and that makes a huge difference in terms of efficiency, right? Same with DeFi. Like, as you said, some things used to take 6 months, and now we can create, due to composability of Ethereum and other blockchains, we can just create stuff in matter of seconds. We can, if I want to deploy a token, I don't have to list it on the New York Stock Exchange. I could create a token and list it on Uniswap. It's done. If I want to create a financial index, I don't need to wait for BlackRock to create it. I can just use set protocol and say I want an exposure to Raptor, Shiba,
Whatever you want.
whatever you want, right? Anyone can do it now. Or like you want to lend and borrow anything, you've got Euler, when you can just borrow, lend absolutely anything. If you want to use anything as collateral, there's some protocols like Kashi or Rari where you can do that too. So I think it's all about like flattening the curve of possibilities for everyone. At a bank, if someone wants to create a structured product that's really weird, they can do it in a second. That's true. That's absolutely true. But only 3, 4 banks can actually do it. Whereas here in DeFi, anyone can. So I think that's kind of also the value proposition, just efficiency.
You're absolutely right. But beyond that, I think there is the 0 to 1 movement, right? So what we had with the internet versus, think, Google versus Yellow Pages, right? Or whatever other example we can think of. It just disrupted the whole ecosystem. Everything started working differently, right? So instead of having a set of small roads here and there, suddenly it's a massive highway which connects the whole world together. And just the same effect that internet had on a lot of traditional industries, finance hasn't, in big ways, finance has been affected by the internet, obviously, right? Because the speed of information and transactions and what have you. But the nature of the relationships in the financial industry has not changed.
That's true.
So DeFi is changing that, right? So what internet did to Yellow Pages and many other sections of the world, crypto is doing to other and broader set of industries, and DeFi is doing this to finance.
Like the efficiency itself creates innovation in a sense, because now that you can build all these things on top, if you tap into composability of crypto, you can build things that you just never imagined before. Like the fact that I can create an NFT, now I can, if I own an NFT, what if I want to borrow money against it? Okay, now I can do that. What if I want to securitize this entire thing and fractionalize it, and people can lend and borrow against it now? And, like it just creates this, it taps into this ecosystem that creates innovation that was not there before with finance. It's just too fractured. I could own S&P 500 and use it as collateral and borrow like some stable coins against it back in the day, right? Unless you have banking relationships, which now you don't need anymore because there's no custodians, there's no middlemen. Like you can just do it now as a simple person, which I think, again, flattens the curve of possibilities for everyone.
Absolutely. And it's all composable, right? And it's permissionless and it's open. So if in your previous example, if you work in a top bank and you create a very sophisticated product, it's only available to a closed loop, right? To a group of your clients, your business partners, which is a small fraction of the global population. But here, everything you publish on the internet, you publish on the blockchain, and anyone can use it and B, build on top of it. And when you allow for that open innovation, there is no limit to human ingenuity and creativity. So I would be willing to bet that the real killer apps of DeFi have not even been invented or conceived yet.
Okay, that's a good point. I love to know, because I've been talking to people in the investment space such as you, and a lot of people, they tend to say that in the next 2 years, the window of opportunity for real innovation in DeFi is going to start to close because the industry starts maturing. You could argue, like, there were a couple really innovative DeFi projects like Uniswap, Compound, a couple others. But what do you think is the future? Like, are we reaching maturity? Like, because when you think of it, if you replicate traditional finance in DeFi, we might be getting close to that point at this stage, wouldn't you say? We have exchanges, we have lending markets, we have margin trading, we have what we need, permissionless options and futures. Maybe that's
We
what's
kind of
happening.
have that already.
We
to a
kind of
certain
have it.
extent.
Exactly, yeah. So we're getting to the point though where what is next? What's beyond this? Are we maturing or not?
Well, I mean, if I knew, I would be trying to close some angel or VC deal. Honestly, I think you're right that when you're recreating a new system, you obviously start by doing the same things but better, right? So it does make sense to have decentralized exchanges versus centralized exchanges. Permissionless lending versus traditional banks, so on and so forth. And yeah, once you replicate most of the products, where else do you really go? So I do think that the base layer is kind of done, but I guess my point is that we can't even envision what the future could hold. So again, let's use the metaphor of internet, right? So it's kind of hard to deduct or deduce where we are in the crypto adoption cycle versus the internet adoption cycle. But I think we'd probably agree that it's mid or late 90s. Well, probably late 90s, but not at the thousands. So if that's indeed the case, then by that time, the internet basically barely replicated some of the basic infrastructure, and that's when you have the apps that started being created. So I think once we create and replicate the existing financial system at scale, because obviously I think we have about 3 million unique DeFi users to date, if I'm not mistaken. I think that's the latest number I saw on Dune. So that's still a small fraction of even the crypto universe, right? So once all of these things work at scale, we will see something new. I just don't know what it is. I do think the window of opportunity in DeFi is shrinking from the you'll not get the same outsized investment returns, right? You'll not get 1,000x on something which is, well, not obvious, but apparent. So that's pretty clear. So the next wave of innovation has to be harder and more difficult. But crypto so far has shown no limits to human creativity. So I don't think it will stop.
That's fair. I suppose in terms of base layer of DeFi, we're probably there. Like another year, the base layer things, like as we said, lending markets, exchanges, options, that's kind of there. But the question is what's built on top of that?
Mhm.
If we think about things like the metaverse and NFTs and how people go into the metaverse and instead of, exchanging, fiat money, they exchange value through NFTs,
Mhm.
through, they trade. Dude, I met a guy recently, and this is really exciting. They have a company, I can't remember the name, but the company is trying to encapsulate human emotions into an NFT.
Reactions.
I'm not sure. It could be that, but they're trying to encapsulate the
Mhm.
emotions into human emotions into NFTs. Which, as a trader, I have these weird thoughts that now we can trade human emotions. Obviously, it's a natural thing. But think about this: if you in the metaverse you want to measure someone's popularity,
Mhm.
do it through emotions, and now you can encapsulate that as well. And just the economy is building around that idea is just insane. Like if somebody is very well known, like a celebrity, and they have social capital,
Mhm.
if they suddenly feel a sudden emotion towards you as a person, that has value, right? That's a unique feeling that can be capitalized on. Or you
Yep.
could, I don't know, you have a wife and somebody's betting on you not loving her anymore, and they just short sell your love. I don't know, like there's so much
Yeah,
stuff
that
you can.
sounds like a good game to play.
Sounds awful, actually, but
No, but I think that's a great point because like what are NFTs, right? NFTs are not these crazy pictures of dogs and cats and penguins. This is actually a piece of internet you can own, right? It's a piece of digital content, whether it's an emoji, whether it's a gun in a game, whether it's a picture, whether it's some IP or whatever it is. We haven't yet seen what could really be built with those things, right? So you can go and get a mortgage against your house. Can you go get a mortgage against your tweet?
that's fair. It's just,
Or whatever else, right? So that will be insane because we're spending most of our days online,
mm.
and the next generations will spend probably a higher percentage of their lives online. So there is more to explore there.
And you wonder actually, because everybody talks about inequality, but the fact that old people have stocks and young people have nothing. If young people spend all their time online, and now we have NFTs that effectively encapsulate value of whatever's happening online, you could argue we're going to the world where inequality is not going to become so much of an issue. Once you start getting paid for playing, for watching content, you're an investor into everything you interact with. Now, you have young people who, just go about their daily lives and they, do things over the internet and they own this. Now they finally can
Hmm.
just say they have capital that you can use as collateral to, as you said, borrow a house against it, because why shouldn't it have value? Or a viral video. People say meme coins are a joke. If a viral video is something that every marketing agency is striving to achieve, how can a meme coin not have value? Right?
Agreed. I think that's a great point. Obviously, we've seen this with the play to earn, and maybe it's a good time to go back to one of your original questions about what's the value proposition of DeFi, right? And the value proposition of crypto and DeFi is obviously a subsection of that. Is that you are paid to be a user, right? So there's this famous saying in Web 2 that if you're not paying for a product, you're a product, right? So Facebook is the best example of that, obviously, as you are the product, they're consuming your data, and that's how they make money. In crypto, you have play to earn. So if you play a game, you can make money off that. You breed some beasts and you sell them, and you make money. There are a few successful case studies there. But the same goes for DeFi. So our fund, for example, gets paid to borrow on some platforms. We get paid to be an early user. If you have an account with the best bank in the world, you're the one paying them ultimately, and you hopefully get some value as well. But imagine that you are a customer of a bank, and for every second where you have money on deposit, you get a share of that bank. So that creates loyalty. That creates very different set of incentives, and it just changes the whole dynamics, right? We had this with the airlines using the miles as a marketing tool, but obviously they have no secondary market value. You can't really trade them. You can't really do anything with them apart from obviously using them for the flights, and obviously they inflate them away, right? So every year they become less and less valuable. But DeFi is the opposite, and I would bet you that over the long run we'll see that there is much more attrition when it comes to customer loyalty, because you get paid to be a user, right? You get paid to experiment and build and use.
I think it's also very important in society that we shift from a perspective of everybody is paying money in rather to society where people own things.
Hmm.
That's what any conservative government in the UK has always dreamt about. This here it is. Like, people can be asset owners through NFTs in the digital space rather than necessarily, rather than a house, for instance. And that makes them asset owners. When people are asset owners, suddenly they start caring about things they normally don't care about, like taxes. Oh, how much am I paying in terms of tax? What's the accountability of government when I have to sell some of my NFTs in order to finance this budget, right? People don't think about that stuff when they're employees. But once you're an asset owner, and it's substantial because you generate activity all the time, you're getting paid for it in assets,
Hmm.
the society starts to change. And I think that's why NFTs do. That's kind of crucial here and beneficial, in my opinion.
Absolutely, and this creates global mobility and makes the whole world, hopefully at some point, more efficient and hopefully a bit less violent.
Exactly.
Without
Hopefully.
going too much into politics.
Yeah. Okay.
So, speaking about DeFi and this level of situation, right? So, as you mentioned, we obviously have quite a few lending platforms there. And they have their pros and cons, but they do exist at reasonable scale. So, obviously, Euler is a permissionless lending platform, right? So, it would be great to hear your thoughts about, how you guys came up with the idea to build this. And how did you find that niche for yourself in the growing market and in a relatively saturated market? And how are you just thinking about, where you fit in and what you do differently?
Sure. So, little intro into Euler. We are a permissionless lending protocol built on Ethereum. We recently raised a Series A with Paradigm in July, and now we're due to launch very soon. And what Euler is trying to achieve is fill a niche in the market where you have permissionless lending and borrowing markets, which is not the case for Compound and Aave. Token holders are saying, we want this token to be lent and borrowed on our platform or not. We think it should be permissionless, while at the same time respecting kind of basic risk management, decreasing systemic risk. And that's kind of the market niche we're going for. Something that institutionals and retail people could use that would be safe, but at the same time in the spirit of blockchains, which is permissionlessness.
That's interesting. So there are some platforms right now that do allow permissionless listing, right? So how would your approach be different to what they're offering today?
So if you compare us to other protocols, like for instance Kashi or Rari, which are have their own kind of ways of doing things, um, they allow anyone to do anything basically. If you want to use your tokens as collateral, as long as there's somebody who wants to borrow, that's fine. Um, on Euler, it's slightly different. There is a big theme about risk management, which means only certain things are allowed as collateral. That is done in order to unleash capital efficiency because we don't fragment liquidity pools. There's only one pool for Ethereum. There's only one pool for Compound, unlike other protocols where like you can have an isolated pool between Sushi and Uni, but another one between Sushi and Ethereum, right? In our case, it's one pool, which is great from capital efficiency point of view, but that also means you have to be very careful about what you list as collateral. And this is where we have a kind of a comprehensive risk framework. So we don't allow systemic risk to blow the protocol up.
Okay. So, Serafim, so you mentioned that there is some governance process in some of the larger protocols right now that controls which tokens, well, governs, not controls, but governs which tokens are listed and what ratios they have and parameters they have. There are some other platforms which are fully permissionless, where you can literally do whatever you want. So if I want to create an Evgeny token and create a lending and borrowing pool, assuming I can convince people to use that pool, people will jump into that, assuming the rewards are obviously attractive. So there are some players that allow that right now. So when you're raising your institutional venture round, right, and I'm sure you have to convince your investors that apart from the team being great, there was also a market niche for that. So, and I'm sure they pushed you and asked you, well, there are kind of people doing something what sounds to be similar. So how are you guys different? What are you doing better or differently? And what is the problem that you're solving in the market?
Yeah, I think when it comes to this, risk management creates capital efficiency in our view. If you have robust risk management where you try to contain systemic risk, you incentivize institutional guys or just big, whales to lend. If a lot of people are lending and it's a well diversified lending base, you increase capital efficiency because utilization is going to be less volatile, which means interest rates are going to be less volatile. And as a borrower, that's good for you because if just one guy lends into a pool, and the moment he withdraws, utilization goes to 100% and interest rates hit 500% APY, that's not capital efficiency, right? Now, if somebody wants to create that market, that's great that we have this. But if you want to unleash actual capital efficiency with diversified lender base and less volatile interest rates, you kind of need to have one pool for one asset. And that's sort of the argument, At the same time, in order to decrease the risks, you need to kind of have a comprehensive risk management. This is what we've created. There's a way to rank assets according to volatility, to liquidity, to centralization, smart contract risk, so that only high quality assets are allowed as collateral. And that significantly decreases systemic risk, which is what creates capital efficiency as well.
So basically, it sounds like what exists in the market today is either, let's say, very efficient risk management system, but then tightly controlled, and then the other end where there is no need for a very sophisticated risk management system because everything is segregated and separated, right?
Exactly.
So therefore, there is no contagion risk. Therefore, why bother about doing too much on the risk management side?
Exactly, yeah. But if you want to unleash real capital efficiency, you need to have proper risk management, sort of to have one pool for one asset. And that's what we're trying to solve for.
And how should we as DeFi users or DeFi investors think about risk and risk management in DeFi? Because there are obviously traditional metrics, on the lending side and what have you, but also you don't have a team of risk managers sitting in the bank with a pen and paper and discussing how to approach things. Everything is codified. And whenever there is code, there is room to manipulate it, right? So over the last few months, we've seen a lot of price manipulation and very complex kind of code, code attacks, basically. So how do you guys think about managing the credit risk and the smart contract risk?
Yeah, I think it's useful to have a look at how these attacks usually look like and how systemic collateral assets are. So if I use Seraphim token as collateral, for instance, whoever is crazy enough to borrow against that, whoever's crazy enough to borrow against that, go ahead. But what happens is, if it's a very liquid asset, Seraphim token, and you lend it. Oh, by the way, we're speaking about over collateralized loans here, so I have to lend something to borrow something, right?
Mm-hmm.
So if I were to deposit Seraphim token, and then I was able to pump the price by 1,000% because it's very liquid, which often is the case. That basically means that if I pump the asset, now I can borrow a lot more against it than usually I would be able to. So I can just run away with a bunch of Ethereum, and that's it. And people who are lending Ethereum out, they are facing the prospect of bad debt because they can't get their money
then
back.
it would just leave this bad asset sitting on the balance sheet because you actually don't care about it, right? Because you just pump the price.
Yeah, it's like you don't care about Seraphim token. Actually, the risk, the pumping the asset might cost you, let's say, 20 grand, but you've stole $3 million worth of Ethereum. So that's a pretty good trade, and that's systemic risk because you leave just because Seraphim token is illiquid. You leave Ethereum lenders without money, and so the contagion has spread to another lending pool, which is an issue. Or alternatively, what you could do, I mean, it's I don't know why people would do that, but economic incentives are not quite there. But you could collapse the asset price of the collateral. That way, all the borrowers that borrowed against it are stopped out effectively. They have to be liquidated. Why you would do that? There's probably lots of reasons for, I'm not aware of at the moment, but that's another thing that's risky about illiquid collaterals. When it comes to illiquid borrowed assets, there's also risks. It's not as systemic. Well, either way, it would be pretty bad for lenders of those borrowed assets. So if I used Ethereum as collateral, which is pretty okay, and I borrowed Seraphim token, and somebody could easily just collapse the price of Seraphim token, now I can borrow a lot more Seraphim token than I normally would be able to, and I can run away with these assets. Now, if it's illiquid in the first place, maybe it's not as valuable, but that's an attack vector that is not as systemic, which is why we put so much kind of effort into assessing the value of collateral, the kind of liquidity and volatility of collateral assets.
And so, sounds very complex, and sounds like you have to get a lot of things right, to manage this properly. So, over the long run, what is the key advantage to the DeFi ecosystem, whether it's lenders or borrowers or both, to gradually transition to solutions like yours? Because I would bet you most people in DeFi wouldn't even think about this risk. They could understand them if they wanted to, but at the moment, obviously, people are quite generous with their time and tokens. So I'm curious how you guys thinking about the longer term kind of differentiation, and whether you think this capital efficiency is kind of material enough to move the needle.
As a trader, I could tell you for sure, like, you don't remember the good times, you always remember the bad times, right?
That's true.
The more people lose money, the more they start caring about this stuff. It's what inevitably happens, especially when you have a big balance sheet and you raise investor funds and you start losing them. I think that's where, like, it inevitably will kind of converge to something safer. So so that
you don't care till you do.
You don't care until you do. That's the sad thing. It's just such a human thing to only care about after things go wrong.
Yeah.
Unfortunately, inevitably, that's what's going to occur. So, which is another reason why we've spent a lot of money on audits as well. There's people underwriting, like, actually some of our auditors actually might not make money if we get hacked, for instance. So that's a nice alignment of incentive of Sherlock that we've done. I think that's the value proposition ultimately, to be honest. But there's quite a few interesting things, like, as a trader, probably somebody from TradFi would appreciate, the liquidation space was quite inefficient until Euler, I'd say, because if you, let's say you borrow and you have $10 million worth of, like, borrowed asset, and you hit your liquidity threshold because the collateral asset went down or your borrowed asset went up. Nowadays on the platforms, you have 5 to 10% liquidation bonus going to the liquidator, which means the borrower of that token essentially has to give away 10% of his collateral, or multiplied by how much it was, was liquidated to the liquidator. That's a huge value transfer. You have a $10 million trade for essentially not so much work. And that's where, therefore, we kind of implemented the Dutch auction mechanism, where if someone's profitable at 2% as a liquidator, they can just take that and go away. That should decrease the spreads or liquidator bonuses. I think of them as spreads. But another feature that's quite cool, if you get liquidated, you typically lose half of your loans, which therefore a big chunk of your collateral just goes away. That's not a really cool experience, to be fair, as a borrower. So that's why we have a stop liquidation procedure where if you get liquidated, you are back to the green and a bit on top of that for safety reasons. Therefore, you're not losing 50% of your loan most of the time. So it's a much more pleasant borrowing experience, which I think is long overdue in DeFi.
I think you touched on a very interesting point, which is liquidations. So all of our DeFi listeners will no doubt be familiar. Hopefully, they haven't experienced it themselves, but they will know what liquidators are. But those who haven't necessarily used the DeFi platforms may not be familiar with it. So, to me personally, once I was able to kind of, at least at a high level, business level, comprehend what liquidation does, for me, that was one of those 0 to 1 innovations that got me excited about DeFi. Right. So I think the primitive way to think about liquidations is, in a traditional world, you default on your mortgage. The bank has to foreclose on your property, which will take them 6 months, 9 months in this, political economic climate. Then they have to give the asset to a collection agency, and they'll liquidate the asset. So a year later, you as a bank, you're kind of getting 80, 90 or whatever cents on the dollar. But in DeFi, it happens in one block
Exactly.
with the liquidations, because it's all, well, it's not API, but it's programmatically connecting and liquidating everything. So do you think that liquidations are kind of pests, who leech on the poor and greedy borrowers, or do you think it's a key function that actually maintains the viability of the whole ecosystem? And then if they do maintain this viability, is it fair to give them less or give them more? How are you thinking about that?
I think they perform a very important function at the end of the day. It's just you could argue they're getting paid a bit too much for it on average. So that's the argument, that it should be market based how much you get as a liquidator when you perform this function rather than a set 5 or 10%. But just briefly about liquidations, what they are. Again, if you lend out your Ethereum and you borrow, let's say, Uniswap token, and Uniswap price goes up, that means your liabilities are going up while your assets stay the same. And that's the same scenario as with the mortgage. You're due to liquidation. And that depends on what exact level of liquidation is. But let's say if you lend $100 worth of Ethereum, your liquidation level is 0.8, which means if your Uniswap token, is worth $80, you're subject to that liquidation, right? So a liquidator would come in and say, okay, I'm going to, let's say, take some of your liabilities away from you. At the same time, some of your collateral as well. And on top of that collateral, I'm going to take a little bit of a bonus. And that's the service fee basically for performing this function. So as you can see, I've taken away some of your liabilities. I've taken away some of your collateral and a bit on top of that. Now you're in the green. No, you've been liquidated. But every time I do that, I take this bonus. And if it's 10% or 20%, that means there's actually an interesting risk. If the liquidator bonus is too high, there's scenarios where if I liquidate you, you keep going back into liquidation because I take too much collateral from you. And there's a way to model it, but that's another reason why they shouldn't be too high.
Interesting.
And you have this dynamic where there's constant payouts by the borrowers to the liquidators. If it were 1% on a 10 million account, a lot of people, as in liquidators, would be profitable. So why should it be 10%, right? It can be higher because of gas. So the interesting feature actually on Euler is that you're going to be able to take on market risk when you liquidate, which should decrease the spreads even more. So let's say I take on your debt and I take on your collateral. If I think that the collateral asset is actually going to bounce in price, I can repay this debt and sell the collateral later because the collateral value is going to go up. So that way, I can say I'm going to be profitable 1% liquidator bonus because I can manage this risk pretty well. I take on the debt, the collateral. Let's say Ethereum is the collateral, it bounces 2% in price, and I can sell at that, and I have repaid the loan and got the collateral back. So it introduces basically trading floor market making dynamics, which we haven't seen in the liquidator space before, which should make it even more competitive because now you have people competing for the bonuses with market risks.
That's very interesting because at the moment these liquidation bonuses are fixed on each of the platforms, and presumably they overpay a little bit just to have the confidence that the liquidators will go and step in when they need to step in.
Yeah.
So there's probably room to optimize this.
Yeah. That should decrease the gas fees as well, make it less MEV kind of prone because you're not competing for this 10%. It's more like there's game theory now involved. Maybe you're profitable at 2, maybe at 3, maybe 4.
Makes sense.
So since we just discussed risk management, what about Re7 capital? Like when you look at a project, what makes you think this is a good project? I want to park my liquidity in. This is a red flag. How would you kind of manage these risks and rewards from providing liquidity?
I mean, we obviously only care about the memes, right? If the memes are good, then the project is great. Uh, the reality is that at this stage in the market, it's obviously more art rather than science. Because when you deal with any DeFi project, there are different sets of risks that you take, and it's important to isolate these layers, quantify them, and then kind of choose them. And probably what will also make sense for me to mention is that so we are a stablecoin centric fund, right? So our objective is to provide our investors with the very lucrative yields in DeFi without taking on the directional price risk. So the first risk we run is that the specific stablecoin we use collapses in value, right? And that's sometimes it's a DeFi specific risk, sometimes it's a risk of centralized companies that issue the stablecoins. But leaving that aside, uh, it's really difficult to analyze risk in DeFi because the risk, I mean, the financial risk, if you have some expertise, you can analyze it pretty clearly. But the main risk is on the code side, is on the smart contract side, right? So if I'm, for example, using an overall collateralized position with a prime broker, I kind of know how it is and how it works. And yeah, there is a risk that some other funds will manipulate the price, which of course they would never do. They would manipulate the price, assuming they know where I can get the margin call, and then I run some risks. But again, that can be managed. It is much harder to imagine a scenario where the bank gets attacked by hackers in a successful way, because touch wood, this hasn't really happened at scale with large, prime brokers and so on and so forth. So we have to analyze the quality of the team, and if we feel comfortable that there won't be basically a rug pull, right? Because DeFi and crypto are at a very interesting kind of time in their history where all the code is public and you can look at it and you can analyze it. The reality, however, is that this code is very difficult to analyze, and the odds are that you will miss something when you look at it. So our first assumption is that we do look at the code. We have I'm fortunate to work with a team of very smart people who can actually read the code and analyze the code. But our assumption is that we're always going to miss something. So therefore, you need to just do your kind of fundamental analysis and have a belief in the team that they will do right by you, and they will not run away, because there is a risk of hacks, but also there's a risk of rug pull where sometimes there are anonymous teams where you don't know who these people are, and therefore it's quite tricky to place your faith and your capital into them. And then you have to understand how to think about risk, right? So we study their code, we study their documents, we study the fundamental risks of the platforms, and we try to basically come up with a risk ranking system and see if we believe that this is something that is legitimate and battle tested, and then we rank it and we adjust the position size accordingly to try and capture the best unit of return divided by the unit of risk.
I'm wondering, is there some sort of a rule of thumb from your experience that it kind of indicates that a team is less likely to do a rock pool? Like, have you derived any interesting indicators?
It's not scientific, but it's not that hard to come up with a basic rule of thumb. So if these people have public profile, and I don't mean they're celebrities, I just mean at least you know who they are, because quite often it's just a picture on the internet. So
Or an ape.
exactly. Well, yeah, I'm sure a lot of our listeners will say if someone is an anonymous ape, it's probably better than
You could argue, actually. Yeah.
you could, yeah, you could. It obviously helps to know who the investors are, because some investors are well known, some venture funds, right? They're well known to do some very serious due diligence into the teams that they back. Not all the funds do, but we try to work with those who do. And then their general ethics and kind of discipline when it comes to code and how they treat it. Actually, just by looking at that, you can arrive to a lot of different conclusions. So when my colleagues and I look at the code, sometimes there are pieces of code missing, or you can actually see that a lot of code hasn't been published.
Mm.
So then you ask the team why hasn't been published, and then if you don't get a clear answer, then probably you should walk away.
Yeah.
So it's not that hard to kind of cut a lot of the noise, so to speak. But obviously, the problem is that even the best intention, people with best intentions and very smart people, they can still get attacked by hackers and they can get attacked successfully. And here is where insurance comes in, apart from the basic kind of common sense risk sizing of the position.
It seems like oh fuck, I lost my train of thought. It seems like basic transparency and having a public profile is it. It helps with finding good teams basically.
Definitely. And I mean, we being very realistic about it, you have a lot of, what is glamorously called DGen money in crypto, which basically, it doesn't mean this, basically you have quite well off participants in this market who don't have to abide by institutional governance standards, right? So we're a regulated fund and we have a responsibility to our investors. If I'm just a financially successful person who made money in DeFi and I choose to randomly spread my bets all over the place, there's nothing wrong with that because statistically speaking, there is venture style payoff in these opportunities. So even if you lose money on 9 things out of 10, the other one will pay you off so handsomely that it's worth the risk. But it's a different risk return kind of mandate. And therefore, I personally believe that yes, just having some basic transparency goes a long way.
We discussed this a bit before, but in terms of returns in crypto, I think because of the tokenization of a lot of these projects, you have very high returns on practically anything, which is not very VC style model, right? VCs are like, well, 90% is going to be completely dead and 10% might outperform or even less than that.
Mm-hmm.
With crypto, because we've tokenized so many projects early on, and you have the beta of the bull market just dragging that, your entire return curve kind of just explodes.
Mm-hmm.
Do you think that's, I mean, I don't want to sound like a traditional finance person, but like, is that sustainable? Do you think there's a case to be made that we are benefiting from the bull market systemically, just because we list on, tokens list on decentralized exchanges, that makes them more likely to just outperform, even if they're not so successful, or we're going to mature to the point where only a few projects actually go up in price?
It's a good question. I think the answer is probably both. So the early liquidity is a feature, not a bug in this case. So I actually had this conversation many times with some of my friends who are concerned about the price volatility of Ethereum, right? And most people in DeFi, hold Ethereum, and that's what kind of gave them some financial success. And they're always, is the bear market coming? Is the bull market coming? But then if you flip the question, and so Ethereum has been around for 6-7 years, right? Well, 6 years basically. So if you have something which has been around for 6 years, the metrics and the fundamental growth is that insane. Is it a Series C, Series D kind of company? If it was a venture project, so then those who bought it 5-6 years ago, they came in at C, the Series A. Now their project is a Series D. It has grown 1,000x, if not a million x. I don't even remember the numbers, and it keeps growing. So I looked at the Ethereum network revenue year on year, and it was up 500%.
Right.
So you're sitting on an asset that is growing at that pace, and I come to you and say, can you sell your Series D investment to me? You will probably tell me no. So I think this liquidity creates a lot of noise and changes things, but basically things do get liquid very early. So if you're a venture fund and you have a portfolio of Series A, Series B companies and they're stagnating, the odds are you can't really sell much. Maybe some of them will get equi-hired and you'll make 20, 30 cents on the dollar, but that doesn't really work. But in crypto, these tokens are liquid. And obviously in the bull market, it's easier to get out, but you can get out to a certain extent. And if you can't, they can be productive assets, right? You can stake them, you can lend them, you can do something else with them. So I think it changes the dynamics, and obviously it will get tougher in the bear market, but I don't think this feature will go away.
Actually, there is an interesting point to be made because of this liquidity. Effectively, you can put more risk, more capital at risk, because now your floor is not zero.
Exactly.
Now your floor is minus 30 or 40, 50%, which is, which basically means you could put more value at risk. So liquidity is actually creating more risk taking, you could argue, which is not like I'm not discovering America really, but but I still think it's quite a significant feature that crypto enables that wasn't there before.
You're absolutely right. So if, for example, you want to lend to a venture-backed company, so there are great funds doing venture debt products. it's an illiquid product that can hopefully perform very well, but you're stuck with it for 7 years. In DeFi, liquidity is, unless you choose to lock it up, is instantaneous. So we, for example, we choose to run a monthly liquidity cycle for our funds, or investors can come in and out once a month. It could be done even more frequently. It's just very painful from the administration perspective. But this is extremely liquid and not too different from keeping your assets on a deposit. So by the virtue of being liquid, it allows you to deploy more capital because you know you can get it out, which, you're right, change the dynamics. And this disposable capital opens up opportunities for more teams, more projects, and creates this positive virtual cycle.
You just mentioned debt, and I actually wondered, what's the scope of debt in crypto? Nobody talks about this, but debt markets in traditional markets are the biggest markets, right? Are we shifting to the space where debt is not as relevant, or do you think that might be the ultimate frontier that is not discovered yet in crypto? Debt. How do you think that?
It's a good question. So I tend to think of debt on chain as something as relatively safe because your positions are fully collateralized and there are automated liquidators. So unless there is a price manipulation or a smart contract hack, you should not experience any losses from the credit side. So therefore, lending as percentage of the whole crypto market is relatively small because it's fully collateralized, right? So in banking, it would be an equivalent of a Lombard loan, right? You have Apple shares and you borrow dollars against it and do whatever you want with them. You don't yet have credit lines. You do have them in CeFi, and we're starting to have them in DeFi. So there are projects like Maple, for example, that basically take on-chain capital and lend it off-chain to some of the most serious and biggest market makers in the world. And Centrifuge lends it to real-world assets, whether it's real estate or gig economy or what have you, but it's still a small fraction of the market. There are some projects working on building your credit history on the blockchain and kind of to assess your viability as a potential borrower. That will be a very big one.
That's a scary thought, to be fair. At the
It
same
is.
time, like I see why this is being done, but at the same time, because it's the blockchain, it doesn't matter if the blockchain's in America or Germany. Like, there's one credit score for everybody, and that's just, I don't know, it's scary a bit.
It is scary and also very tricky because it has all been anonymous, right? So if you default on the wallet, you can go and open up another one and do it all over again. So I think it's a very difficult problem to solve, but so far humanity has been able to solve most problems relating to finance, at least temporarily.
2008, right?
Well, we're still here, so clearly things work to a certain extent. So I think, yeah, it's a big problem to solve, and even when it's solved, it will propel this market in a very, very serious way.
What about financing as a project in terms of debt? Do you think that's like, if you're a protocol or anything, do you think tokens is like the only way, or there will be actually some debt market for this?
It's a good question. So we already have grants, right, where people are able to build something just using free capital, basically. Yeah, sometimes they sell tokens, but I think the beautiful thing about tokens is that I think those who are not deeply in the crypto, they think of cryptocurrency as currency because it's just Bitcoin and it's very loud. I think most of us in crypto think of tokens as equity because we get claim. Well, obviously it's not regulated and it's not a financial security, but they have comparable features, right? They may pay you dividends or. But the point is that a digital token is what you tell it to be. So if you tell it to be an asset that gradually amortizes and pays you a fixed coupon, then effectively it's that. So I think, yes, it's absolutely feasible. And I'm sure there are structures that already exist that work in that way, and it will continue to grow.
That's true, because a token could say not give you governance rights. It only gives you some sort of a fixed payout, and the token could become debt by virtue of that if people don't want to give away the ownership of the governance.
Well, they can still give you governance right because in certain situations, obviously, bondholders in the traditional world they are allowed to vote on certain things um, to a certain extent. So here we can have that as well. But in that case, the key feature between debt and equity is obviously there is a cap on the financial upside, right? And that's this, which is actually slightly different to our fund, for example, because as I mentioned, any DeFi participant who provides liquidity gets paid and gets these rewards, which are effectively tokens. So what is interesting is that you can provide liquidity, you can get some rewards, and sometimes you can choose to sell them straight away, which we prefer not to do. Or you can treat them as equity value, which one day could double, triple, or 10x. And that gives you positive optionality and incentivizes you to take more and more risk, which makes the life of a conservative TradFi kind of boomer allocator tricky, but makes the space very exciting.
It's quite cool. Actually, the risk profile must be very interesting because you earn your interest, you put in that balance sheet at work, and you receive huge convexity in return. So that seems like a pretty good kind of risk profile.
Exactly.
Payout profile, yeah.
Exactly. Yeah, the risk is still there, but the return on that risk seems to be attractive at this point in time. So what we tend to do is we try to help the teams as early as we can, so that basically on day one of launch, we could be there to provide liquidity and participate in that growth.
Nice.
So yeah, we both. So it seems we both agree that tokens can represent any financial payoff. But I guess this more applies to kind of ERC20 tokens, which are governance/financial in nature, or maybe even access sometimes. And then we have a subset of other tokens, which are non-fungible, which could represent digital content and digital IP. So would Euler at some point see itself as being able to lend against such assets?
Oh, we were looking into NFTs quite a lot, into just discussing, not in terms of like doing a project yet, but just discussing what we can do. We feel like we want to do something about NFTs when we feel like that we can genuinely provide value to the community rather than just do something NFT related. Because there's definitely a case to be made that the future will be NFT based. As we discussed, the economy could be essentially be based on people interacting with NFTs all day, every day, which you see at conference. Actually, funnily enough, it's like a teaser for what's to come. So we like to do something, but only when we feel like we genuinely provide value, like we increase capital efficiency, for instance, which is something that's completely lacking in the NFT space. You can get a loan against your NFT, but the process is kind of very manual. You go to a DAO, you have a governance proposal, or it's peer-to-peer. But we need to reach a point where we can do peer-to-pool NFT collateralized lending. And we haven't yet figured out how to do that. But if we do, that could be something.
Is that even possible?
That's the issue because, ERC20s, they all are the same. With NFTs, how do you create this pool? Is it the same collection? But there's so much discrepancy within that collection. Financial manipulation that can be done in NFTs is like, you can just buy NFTs, put in some cheeky bid and voila, So these are the things where, because we are kind of a risk management focused protocol, we need to really think deeply about to begin with, So, but it's definitely something we're thinking about in terms of NFTs because there's a trend there. It's there.
And presumably, I think I've seen there are some platforms that allow you to rent your NFT out, right? So theoretically, you can have an NFT which also generates some cash flows, right? So maybe that makes it easier for you guys to eventually think of it as a financial asset.
It could be, yeah. That we've actually spoken to guys from Solve, so SOLV. They're pretty cool guys. They created a financial NFT, which means these NFTs that contain ERC20s, and they can be unlocked, let's say, in a year. So it's like a vesting contract, really, that trades at a discount because it can be unlocked in a year or two. And that is something more tangible, for instance, for us. We know the value of these underlying ERC20s, therefore it's easier the only risk you take is liquidity and smart contract risk, probably, right? So these avenues, I think these kind of ideas are quite interesting to us. And I think there's definitely something that we could do in the future. It's all about like the value and the, can we increase the capital efficiency without compromising risk management in NFTs? If we can, that'd be something interesting.
It's a $3 trillion question.
Yeah, exactly. Okay, yeah. So, Evgeny, one final question for you, because we have to wrap up. If someone from traditional finance came to you and said, should I jump into DeFi or is it too late? What would you tell them?
I kind of tell people to jump into DeFi before they even ask me, to be honest with you. It's definitely not too late. It's just getting started, right? The industry is 2 years old. It has grown from 50 million in kind of AUM to 200 billion basically by now. The number of teams that are building something is increasing. All the metrics are going one way, and I think it's very hard to argue with that data. So it's definitely not too late, and I don't see how anyone with the energy and the desire to learn and create would choose not to be involved in DeFi if they're interested in finance. So I think it's a no-brainer.
How do you make that jump, you think? Is there something you can do that really sets you apart and allows you to do the jump?
It's the 10,000 hour rule. It's unfortunately very difficult to beat that, but basically, the best way to learn in DeFi is there are probably two things you can do. First is, use every single product in DeFi. Try to lend, try to borrow, try to trade, try to buy decentralized insurance, try to cross from one chain to another using a bridge, and join a couple of DAOs where we haven't really touched on DAOs, but these decentralized communities and decentralized ways of people working together and coming together. It is mind-boggling thing if you come from traditional corporate world, because you realize the world is much more open and much bigger than what you think it could be.
If they can raise $40 million to buy a piece of paper in a fucking week, imagine the stuff that we could do actually with if we put our minds to it.
Exactly. There is no, when you see people coming together whilst having the right incentives in place, there is no limit to what can be built.
Exactly.
Absolutely. And speaking about Euler, what are the things we should be on the lookout for? What should we be keeping an eye on?
So if you're in the community chat, we love to tease people a lot, But I would say watch out for announcements in the beginning of December. There's some really good stuff coming. As a liquidity provider, as a retail person, as anyone, I think you'll be...
That's some alpha right there.
Wag me anyway.
Wag me indeed.
All right. Evgeny, thanks a lot for taking the time. I think it was a great talk. We touched on many subjects and hope to have you back soon.
Thank you, Seraphim.